Well, the markets are celebrating a little bit this morning as the House passed the big, beautiful budget bill early, early in the early mornings today. And Tesla is definitely in the lead on that celebration, and so it should be. And we'll see if this is the beginning of my move, because we're running out of time. So what is exactly going on right now that really should matter to you? And that, of course, is Robotaxi. We're going to look right now at the moats because there's people out there that are suggesting today that once again, kind of the Gary Black story for a while now, but others are chiming in. Well, there are no real moats on this Robotaxi business. And this is just such nonsense. I really felt I needed to deal with it. So we'll take a look at that and we'll get into the economic data later, which actually is quite excellent today. The economic data is really good and suggests that the golden age may already be starting. The chances of recession have fallen to almost zero. Business has been doing pretty darn good. So let's take a quick look here. Bradford Ferguson responds to a note from Tony the accountant. And Tony the accountant says, he says a checklist for dominating the robotaxi market. Number one, the best hardware, the best software, the best data. That goes to Tesla. Number two, the lowest cost in the industry. That goes to Tesla. Number three, manufacturing capability to scale. That goes to Tesla. And then cash flow available to scale. Well, cash flow available to scale, maybe Google would have at least equal, probably even a better shot at that one. So we may have to give that one to Google and Waymo. All right, now let's go ahead and look at what Bradford responded to that. He says Tesla also has 1+ million AI4 available fleet at no extra capex, doesn't cost a thing to put that fleet to work. It has the compute, which was actually mentioned, rock star talents but Google would have rock star talents as well, and a track record for ability to commercialize. But again, I would certainly say Google has that capability, and even I would say that Uber has been pretty good at commercialization. I think you got hats off to those guys. All right, so I thought, well, okay, those are good, but let me tackle this. I think we can do a lot better with an explanation that has more than 6 words to each line. A paragraph, okay? I mean, not crazy, just a paragraph. So number zero. Before you even get to number one, number zero is that Elon Musk is in charge of the effort. This is not no small issue. If you're watching this channel, you're probably going to agree with me that Elon Musk is the greatest entrepreneur on the planet. He's the most likely to succeed at any venture, and the ventures that he succeeds at have massive moats, and this is not going to be an exception. So, number zero, Elon Musk is in charge. Number one, no one else is even attempting to use vision only. Vision only will only work as vision only will work because anyone driving a Tesla on FSD to date knows that without question. In other words, if you're driving FSD right now, you know the vision only is going to be successful. It may be more successful next month and more successful the month after that, but it's going to work. Besides that, we know that Elon just said that the test vehicles in Austin have been driving thousands and thousands of miles without one single intervention. So this vision only is going to work. So number two, which is related, if a company wanted to catch up with Tesla on vision only, the time and the expense required would be literally impossible. No one would be stupid enough to make that investment with Tesla already capable of deploying a massive, massive fleet. And there's a massive fleet already out there bringing in the data. So this is almost like Starlink. Nobody's really going to try to compete with Starlink because you can never, ever, ever catch up. Number three, vertical production. The companies that have the best chance of competing on autonomous ride hail don't make their own vehicles and aren't going to be making their own vehicles. And they aren't making a vehicle that's specifically designed for ride hail. On the other side of the coin, the companies that make vehicles are not even considering ride hail, and none have said they're planning to make a dedicated vehicle. So you can go to General Motors, Ford, Mercedes, Volkswagen, Toyota, None of these people, many of them have said, nope, we're not going to be in the ride-hail business. And none of the others have said we're going to be. Even BYD has not said, oh yeah, we're going to go out there and compete on the ride-hail business. So basically you've got such a massive moat because there's only one company that's going to be vertical, only one company that has both sides already covered in detail. Number 4, Tesla's inference chip. The FSD chip is already by far, not even close, the most sophisticated inference chip in the world for real world inference. And hardware 5 is under development, so it's just going to get better. And again, it's not something that somebody's going to say, oh, we'll catch up on this in a couple of weeks, because by the time they catch up with hardware 3 or hardware 4, hardware 5 is already going to be on the market. Number 5, no company at this time is offering a solution that can be driven on any road on Earth with no experience and no mapping. Tesla has just proven that it can make modifications to the data for unusual driving conditions by using YouTube video inputs, so-called sim to real. They're also going to be now using this for the Optimus bots. Number 6, Tesla's real-world data is unsurpassed. No company has any chance of ever getting close, as Tesla will continue to create more data every single day than any other company can in weeks, months, or years. It's not even close. Number 7, Tesla's data center in Texas is already the largest real-world end-to-end neural network training computer in the world, and Tesla's adding a massive amount of additional compute as we speak. Number 8, Tesla has 4 factories currently that can manufacture cars at scale, and it is the lowest cost producer in each of those markets. Their additional capabilities from AI, and especially from the addition of Optimus in the factory, will give them a massive lead in efficiency that nobody can catch. I mean, it's just impossible to catch, because no other automaker is making, well, that's not quite true. I think the South Koreans are making some robots. Toyota has, or Honda has in the past, but the reality is Tesla is all by themselves in terms of the humanoids. They'll be putting their own humanoids into the factory in quantity, in mass, 5,000 by the end of the year, or early into next year. So it's not even close. Tesla will continue to be able to make the lowest cost vehicle, the lowest cost components, and they are already more vertical than other companies around the world, and already more efficient. Number 9, because Tesla will be able to scale up to 1 million or even millions of vehicles by the end of 2026. And because this is not even remotely possible for any other company, they will have a first mover advantage in every important market on Earth, which is basically the United States and Europe, maybe Australia, Japan, South Korea. I don't consider China to be that important a market for the Robotaxi. They'll probably do just fine in China too, but the cost advantage over having somebody in the seat driving the car, it's just not a huge cost advantage. Number 10, Tesla has a huge fan base and customer base that will prefer a Tesla ride-hail to any other on the market. It won't be close. And Elon, of course, has a massive following on X, which he'll be able to exploit as this is rolled out. This is Randy Kirk. Please hit like, subscribe, and notify. If you liked my list, did you have any things you want to add to the list? Do you take offense, or do you not agree with some of the things that were on that list? Hey, put it in the comments below. I've got people on X right now fighting me on some of the things that I'm saying, but I don't think there's any confusion here. I think it's really a slam dunk. Home sales are down again, but just by 0.5%. Now, it's no surprise that home sales are down, because even as inventories are higher, okay, we're getting a little bit of a bump. It's not huge, but we're getting some more inventory on the market. But I'm not at all surprised. Again, I have a lot of expertise in the real estate area. It's not surprising to me that home sales are down a little bit, because mortgage rates are extremely high, and the mainstream media has created a massive hysteria around the tariffs, causing people to put their hands in their pocket and go, maybe I shouldn't make a big move right now. What I'm going to say to you next, you can go take this to the bank. Mortgages are going to come down later this year. They're going to come back into the 6s. When the mortgages come back into the 6.5, 6.4 range, and when the tariff thing is kind of settled out and the big beautiful bill has been passed, signed by the president, watch out for the real estate market. There will be back to not having any inventory out there by the end of summer. In the week ended May 17th, the advance figure for seasonally adjusted initial claims was only 227,000, which was a decrease of 2,000 from the previous week's unrevised level of 229. The 4-week moving average was 231. That's actually an increase of 1,000 from the previous week. But overall, you would say flat. The advanced seasonally adjusted insured unemployment rate was 1.2%, which is where it's been for weeks or months. The advanced number for seasonally adjusted insured employment during the week ended May 10th was 1,000,009, and that's an increase of 36,000. Now, the number that I always bring up, the one that I care about, the total number of continued weeks claimed for benefits in all programs for the week ending May 3rd was 1,000,008, a decrease of 70,000 from the previous weeks. There were 1,700,000 weekly claims filed for benefits in all programs in the comparable week last year, almost the same number. That would tell me business is fine. Nobody's laying off. People are continuing to hoard employees. But I think what's really happening is business is picking up. So this number is probably going to get even lower. U.S. business activity, growth, and expectations for future output improved from lows seen in April, according to the Flash PMI survey data for May. Improved in April. However, it remained historically subdued among ongoing concern over the tariffs. Let's see here. Input inventory holding, the largest jump on record, because people brought the inventories in, but those inventories remained high because they were still continuing to bring more in. The headline S&P Global US PMI Composite Output Index rose from 50.6 to 52.1 in May, according to the flash reading. That's a huge jump. That rise is a signal of acceleration of activity. From April's 19-month low to the fastest since March, although it remained one of the weakest readings since early 2024. The strongest expansion was recorded in the service sector, where business activity growth rebounded from April's 17th month low, but remained below March's pace. Remember, all these things from last year, the numbers were hugely inflated by the amount of government spending and the amount of government employment. The improved performance was driven by fast rates of growth and new orders. Inflows of work in the manufacturing sector notably rose at the sharpest pace in 15 months, while demand growth for services was merely the strongest since March. These order book improvements were fueled principally by domestic demand as exports of both goods and services fell. So we're getting exactly what Trump said we're going to get. This is exactly what we're expecting, and you'll see there's more. So, although manufacturing reported an easing in the steep export decline reported in March, exports of services were continuing to fall. Future sentiment, having slumped sharply to a 2.5-year low in April, sentiment among companies about their output over the coming year rebounded in May to the highest since January. Sentiment was buoyed in part by reduced trade worries following the pause of additional tariffs. Factory production moved back into expansion territory after 2 months of decline, and new order growth hit a 15-month high. However, the biggest positive contribution came from inventories, which rose to the greatest extent recorded since the survey began. Anyway, employment fell for a second month a little bit, so that acted as a bit of a drag on PMI. Okay, then from Rod Martin, he says, listen, the numbers are staggering. The numbers are staggering. A new Allen's trade survey shows 9 out of 10 U.S. companies plan to shift their manufacturing and other operations to American soil. Let it sink in. What? 9 out of 10. A key finding, U.S. companies are leading the global reshoring race, matching only Italy and Spain in their commitment to domestic production. Then Chamath has this kind of a negative statement, and I kind of agree. Okay, so we got this big, beautiful budget bill that passed last night. I've got, problems with it. I think they should have cut a lot more. Chamath obviously thinks they should have cut a lot more, but Chamath also thinks that they cut too deeply in one area, which Elon doesn't agree with him. So here's what it says. One of the oddest things in the House budget bill was cutting the private market incentives in energy markets. 81% of incremental power generation will be crippled by that single stroke of the pen. How do we compete in AI and compete against China? They have an abundance of power. We are woefully behind. and we need more power immediately. It's almost like these guys want us to lose to China. Okay, Elon said, I don't want any, I don't want your darn uh, 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 incentives. Let's just let everybody compete on a level playing field. I'll be fine. And he's the #1 producer of the battery systems and also a major producer of batteries at Tesla. I think, but by the way, the batteries and the battery all the battery aspects of this don't take place, I think, until I think to the end of 2027, maybe. Yeah, I think January 2028 is when those subsidies go away. They were going to go away in 2030 anyway. So this is just, or maybe 2031, something like that. So this is just a couple of years pullback, and it's designed to help this budget. Now, the end of the $7,500, we talked about that yesterday. That's going to go away at the end of this year. And again, Elon was asked about it yesterday and said, yeah, fine with that. Don't need it. And obviously with Robotaxi, he's going to be 100% right no matter what. Yesterday, I posited that the Treasury might be willing to buy some bonds, some quantitative easing in order to get yields down. Here's a useful article on the subject from Barron's. The bottom line is that the market is effectively tightening, making credit costlier, even though the Federal Reserve has held short-term interest rates steady. So what's actually happened is bond yields have gone way up, even as the Federal Reserve was lowering interest rates. This makes sense because the Fed has said time and again it is paying attention to financial conditions. Treasury Secretary Scott Bessent has been overt about his focus on lowering the 10-year Treasury yields. Investors shouldn't hold their breath, though. While the Fed and Treasury teamed up in 23 to stabilize the markets as the failure of Silicon Bank raised concern that the financial system might collapse, things are different now, according to this article. Although traders have lost big money on long-dated bonds, they move because those move up as yields have been rather orderly. The 10-year has climbed 0.625 percentage points in the last 33 trading days. So that means that the value of the bonds has been going down. Yields remain far from the 5% they were in 2023 when Chair Powell noted that higher borrowing costs could weigh on the economy if they continued. Still, one idea in circulation, they were reading my stuff yesterday or watching my videos, is so-called emergency quantitative easing, or QE, by the Fed. But not by the Treasury, it should say. Quantitative easing typically involves the central bank buying enormous quantities of bonds from primary dealers and in turn depositing money into their accounts, essentially greasing the economy's financial machinery by creating dollars. An argument against QE is that while it took place during COVID-19, a time of extreme market dislocation, conditions aren't so dire now. It might also end up being counterproductive by increasing inflationary expectations, according to George Saravelis, head of foreign exchange research at Deutsche Bank. Tariffs, in a Wednesday note, tariffs, long understood to increase prices, also cut into the case for quantitative easing. I agree with part A of his statement. Yes, if quantitative easing takes place, it might create some additional inflation, definitely some additional inflation. Depends on how long and how much. It might be able to be done in a way that it just like kind of give a hit to the market and then go away type of thing. Treasury, which is clearly more closely aligned with the Trump administration than Powell could step in, they might offer a reprieve, but it would be an unusual move. The Fed is the lender of last resort. The Treasury is known for being predictable. Over the long term, it's the best way to maximize the cost of borrowing. Buybacks could be a partial solution. Since May, the Treasury has been buying older, less liquid bonds that aren't actively traded back from the investors. Last month, it said it was looking at ways to improve the program. That could include increasing the maximum amount of bonds it purchases or altering the mix, essentially increasing demand and lowering yields for certain securities. While a Treasury official gave Barron's no indication of what the changes might be at the time, it could be weighing a shift that would mean an announcement could be coming anytime about some emergency action. It wouldn't even have to be emergency. It'd just be like, we think at this point, this is what needs to be done. Potential buybacks are marginally more likely because the Treasury has raised the idea, according to 𝐄𝐦𝐚𝐢𝐥, head of rate strategy at BMO. But they are unlikely to be executed at a sufficient size to satisfy the market. And to buy back more debt, the Treasury would have to borrow, likely in shorter maturities. Issuing more shorter-dated debt and fewer longer-dated securities could also lower 10-year yields, although it isn't the Treasury's favorite tool. Treasury's next announcement on its plans would come in July. The downside is that issuing more short dated debt means the U.S. would continually have to refinance a greater share of its borrowings. That could mean it would have to borrow at favorable terms. Or the opposite. I don't understand this guy. It could be the opposite. You borrow right now when interest rates are high. You borrow the 1 month and the 2 month and the 6 month and the 1 year. You borrow you buy those up right now because interest rates are going to be coming down almost certainly as the big golden age hits us. Okay, so let's take a look at what with this good business news is meaning for the market today. So the markets are continuing up and to the right. And this is mean that Tesla is continuing up and to the right also. So we're up 3.25 right now for Tesla at $345.50 a share. We're back to pushing up against that 350 number again. I would love to see it break through 350 this week. I would love to see it break through 350 meaningfully, like through 365. That would be even better. It could happen because the FOMO should be ticking in more and more each day, especially as people begin to see this is a reality. This is going to happen. So that's where we are right now. And then we've got everything but Apple is up on the Magnificent Seven. I'm sorry. Yes, up. Apple's down just a little tiny bit. And Apple's probably down a little bit because all those Google announcements yesterday seem to be heavily competing with some of Apple's, things that Apple does. So that would be there. So we've got all of the Cathie Woods are up, except TDOC is down just a tad. Again, also don't know why. All right, let's go ahead and look at bonds. The bonds at this point are down 4.4 basis points at 4.553. That's a crazy number. We need to get it back into the threes, which now seems like a very long way to go. But I think you might be surprised to see how fast this might fall as we get closer and closer to passing the big, beautiful budget bill. We'll see what the Senate's impact is going to be over the next couple of weeks. The Senate is going to be weighing in with where they think the budget bill needs to be different. Maybe they will be saying we need more cutting. That would be helpful. The bonds would probably react positively to that. Continuation of solid business, I think, will also right now be good for bonds. Normally, you're like, oh, if business is good, then the bonds are worried about inflation. I don't think anybody's worried about inflation anymore. So if business is good, I think the bonds will see that as good. That's just me right now today. I could change my mind tomorrow on that one. Okay, so we now have the 2 month is also down just a little bit, 0.4 of a basis point. The 2 year is down 1.6 basis points. So everything heading the right way there. If we go into oil is down last time I checked. We've got oil also, yes, down 56 cents to 61. I think we'll be back into the 50s here in the next day or two. Natural gas continuing down again. Don't know what that big bump was the other day. Sitting at $3.27. That seems like a really good number for natural gas. Gold is down in 1980 after being up. We're sitting just under 3,300 now. It's a good solid number for gold. You've heard Larry say, you've heard me say, I think it goes down as the dollar goes up, and the dollar is going up. Silver down 1.36% to 33.19. I'm not as sure about silver. Maybe I need to do a study. How much silver do they really need for this electronics boom that we're going to be seeing? Copper up 0.16%, sitting right in the middle, 4.68 cents, $4.68, very close to the middle. The dollar is up this morning. Bitcoin is way up, breaking through its all-time high, $111,484. This could mean a lot of things. It could mean it's going to break out and go to 150,000. It could mean that any day it could go back down to 70,000. I don't know. I don't have a good guess as to which direction it's going to go. Okay, so later on today, you got the normal day. You got Nicholas is on Tuesday. You got Bradford Ferguson on Tuesday at roughly 5:15, and you've got Cern Basher at 7:45. It's going to be a great day. What else do I need to tell you? Oh, yeah, last night, I didn't do a show last night. I did the regular show with Brian Wong. You do want to go back. Very good show with Brian Wong. I'll put that card up here right now. But there was no late show last night because I didn't have anything to report that I thought was valuable enough to share with you at that exact moment, because Brian and I covered it all, which is why you need to go back and look at what Brian had to say. All right, so going back and taking one more look at the Tesla shares right now, 3.17% up, 345.22. Let's see, we are at yeah, we have lots of time left in the market today. Let's crack 350 today. Let's get back up to that 352 today. Go to 365 tomorrow, and then next week we start shooting towards 440 and all-time highs. Does that sound okay with you? Let me know in the comments below if you'd be okay with that. This is Randy Kirk. It's been great talking to you.